And let's welcome a very special guest, Pradeep Shah, Chairman at Indasia Fund Advisors, joins us on the show. He now has added responsibilities as well. And Mr. Shah, good morning and congratulations. Haven't had a chance to you since you got an additional role on the government side as well. Congratulations on that. I just want to start off with your thoughts, though, before we talk about banks by and large, on whether you believe we are at a precarious situation on an equity markets perspective, considering not just what's happening to the local macro, but also on the global front as well.
Yes, I think we talked on your channel a little while ago that with oil prices rising and then the current account deficit increasing and the dollar appreciating versus the rupee, plus US interest rates rising, and then the US-China trade problems as well as trade dialogues or threats, and the sanctions against Iran and so on, all that does cause some concern for me. I think the Indian markets were headed down at that time. We're doing well, but I expected them to head down as we discussed at that time. Even though the economy is doing well in terms of demand because of 2 years pent-up demand with the demonetization and the GST issues, the good monsoons, relatively good monsoon last year and the better monsoon the earlier year, all that pent-up demand is now reflected in almost all companies' product sales. But where we still have this fear is this the US interest rates going up and the current account trade deficit, and most importantly, in our own country we have looming elections. And we saw in the Karnataka elections, while the BJP did better than the last time, there is fear that it might not get the same kind of mandate that it got in 2014 next year, in which case will it be able to make as effective structural changes and tactical changes as it would like. So that concern, I think, is going to accelerate going forward, and therefore what you say, markets have to be viewed with concern going forward. They will not necessarily be going up. It'll be individual stock specific movements upwards, otherwise the tendency would have to be going down, drifting down.
Mr. Shah, do you believe the markets will price in the impact of all of these well before the event does happen? The market tends to look forward, assuming that there is a realistic chance of the mandate not being completely in favor of the BJP in May 2019, or for that matter, there being more rate hikes and more weakness for the emerging market bonds and currencies as opposed to what we're seeing right now. Do you think it will be bunched up and factored in over the next 3 or 4 months? Is there a realistic chance that we skating on thin ice and might just crack very, very soon?
I think the drift downwards has already started in anticipation of these political uncertainties coming to reality, and also because of this oil price being so high, which hurts India very badly. So I think, and you see the currency also has dropped, so the foreigners are pulling out. Now, I think here's one opportunity for the government to tweak some things to bring back that interest in India from foreigners, whether in equities or debt instruments. And one of these is the dividend distribution tax for equities. If they were to tweak it so that institutions overseas can get credit for the tax paid here in their income returns overseas, it would make a huge difference to them in terms of net returns, and it doesn't cost India anything in terms of revenue loss. So I think government will have to be a little more proactive. And of course, for our domestic scene, we must continue on this growth path and accelerate it. So government must, which is doing extremely well, spending on infrastructure projects and timing the infrastructure projects evenly, timing the infrastructure spend evenly throughout the year. But in addition, it must continue the focus, which it has reduced just now, on ease of doing business and ease of living. I think that is where the bureaucracy is seen to be the enemy of the people and enemy of the government, and I think that must be corrected. The government must shake up the bureaucracy to be in sync with the government's thinking and Prime Minister's thinking of ease of doing business, creating investment, creating job opportunities. Today there's so much, unfortunately, friction because of the bureaucracy.
Mr. Shah, good morning. What is the likelihood that we can see a change in the RBI trajectory, the rate trajectory this year, and what kind of implications can that have on Indian equity markets?
You know, I cannot predict what the RBI will do, but I would like to suggest that RBI will relook at what is apparently its policy objective in its monetary policy. You know, everyone knows that it is very conscious of price stability, which is wonderful. But in addition, as in the UK, as in the United States, the central bank is required by law to also look at full employment as one of the objectives of monetary policy. And in the UK, of course, price stability is the principal objective of monetary policy. But in addition, the Bank of England it takes the view that it should support government's policies on economic growth and employment. So I think if that were to be expressly visible in RBI policy, it would bring a lot more confidence in the minds of people, and RBI would not be the butt of everyone's comments that it's not reducing interest rates or whatever. I mean, it is very conscious of inflation, which is very good, and I think that is one of the great things about our RBI.
Right, Mr. Shah, then shifting focus to equity markets, well, what have you made of earnings, and can we expect that elusive double-digit growth in the markets in FY19?
You know, the earnings will do well. I think will continue to do well because there's a momentum in the economy. The demand is very good, whether it's in consumer consumables or in consumer durables or in even industrial products and capital goods now. So that will happen, but unfortunately, I cannot see justification for the markets increasing as a whole. Individual stock-specific improvements, certainly, as you pointed out earlier, with the results that, for instance, NATCO has shown, it's jumped up 4% and so on. So those kinds of things will happen. But overall, the market has to take into cognizance the uncertainties of the elections and the uncertainty of the government getting the same kind of mandate, the present government getting the same kind of mandate as it has had so far, as also the uncertainties on account of the currency, with money flowing out, with current account deficit being so high, the oil going so high. I don't see what is the logic for the market to go up from here for us in the future.
Yeah, no, I think the question nowadays, Mr. Shah, is not about whether the markets will go up or no, but if they stay put, then at least the mid caps and the small caps, which are delivering good numbers, could do well. But I understand your point completely. I have a tricky question for you, Mr. Shah. I don't know if you're in a position to answer that, considering you are now on the Banks Board Bureau. But the shunned out public sector banking space, do you believe as an investor, is there a chance for revival? And I don't know if you can answer this question, so take my question with a pinch of salt.
You know, I'm not speaking as a member of the Banks Board Bureau just now. I am a member, but that's not the subject matter of our discussion. So I think the public sector banks have still to undergo a lot of pain. I know the chairman of State Bank of India has said that the worst is behind it, but that's maybe for State Bank of India. I fear that there is a lot more pain left to be visible in the bank balance sheets and profit loss accounts. And one of the things, regrettably, is that when government decided to give capital to the banks, it was as if independent of the banks' kind of losses. If you remember in 2008, when Citicorp was bailed out by the United States, Fed and Deposit Insurance Corporation and the Treasury, what they did was they identified the pool of toxic loans and said that 10% of the losses on those toxic loans would have to be borne by Citibank, and the rest, 90%, would be absorbed by these institutions. Now, unfortunately, we have not had that kind of linkage. So what I'm seeing is that the creditors' committees of these banks and so on are relaxed about how much losses they have to take. I mean, they try their best to maximize it, but they're not making any extra effort to maximize their returns from these toxic loans. And that is a big negative, I think, for the public sector banks. That, the creditors committee feels that, oh, it was not in my time, or it's not my responsibility, I have to just solve this problem out. They must take a proactive stand and say we must maximize returns from our bad loans, so that they preserve capital and don't have to keep drawing on government. And government is giving its capital kind of very easily.
Okay, I have one final question, Mr. Shah, and that is on the oil dependence, if you will. The OMCs are in eye of a storm, and there are 2 or 3 measures that the government can take. Which of these would be the most prudent one, considering that if they ask the upstream to bear a part of the subsidy, it may be great for the downstream companies, but then the upstream companies come under a cloud as well, and the government is trying to ensure, I'm guessing would be trying to ensure that one doesn't benefit at the cost of other. What do you think is a possibility available in front of the government?
I think you're absolutely right. It would be completely unfair of government to put a portion of the subsidy burden on its public sector units, almost all of which have private participation from the public. So I think it would be completely unfair. If government wants to take a hit itself, it can reduce excise duties. Now that itself may help in the consumer perception as well as in votes, but it will be at a cost of revenues for them. So maybe they will have to make up revenues in other ways, by way of divestment or by cutting back on expenditure which is infructuous or which is of revenue nature, so that they continue with the capital expenditure but don't have a fiscal issue coming up. I think if anything has to be done, it should be on the excise front, and they should bring down a little bit of excise to alleviate the problems for the consumers. At the same time, on a long-term basis, they must go ahead with public transportation, not encourage this private transportation. Public transportation is so much more economical.